This is the Daily Market Comment by Marios Hadjikyriacos and Maria Pachordavis. Thanks for joining us at XM.com. The Japanese yen has been blown to smithereens. Central banks around the world are raising interest rates to combat spiraling inflation, but the Bank of Japan refuses to play this game. That's because there's no inflation to fight. The annual CPI rate in Japan is still stuck around 1%. BOJ Governor Kuroda tried to slow the bleeding today by saying that the yen's rapid weakening could have some negative economic implications. However, his remarks were eclipsed by another spike higher in global bond yields, which pushed the yen to fresh two-decade lows against the US dollar. There's growing speculation about FX intervention to save the yen, although that seems unlikely. The yen's troubles will likely persist until the BOJ loosens its yield curve control and allows Japanese yields to trade higher. The economy improving and the yield ceiling becoming harder to defend as foreign yields race higher, that could happen as soon as this summer or fall. In the broader FX complex, the dollar continues to steamroll its rivals, turbocharged by expectations that the Fed will raise interest rates with brute force. The frantic rally in U.S. yields shows no signs of relenting, with the 10-year Treasury yield crossing above the 2.86% mark today for the first time since 2018. This is an ominous sign for riskier assets like equities. Accordingly, shares on Wall Street are poised to open in the red today. The bond market's in disarray and the earnings season kicking into higher gear this week, the turbulence is likely to continue. Most European markets will remain closed for the holidays. Crossing into commodity markets, the rally in gold remains an unexplained mystery. Bullion keeps grinding towards record highs, even though the dollar continues to appreciate, and real U.S. yields are about to cross into positive territory, both developments that should knock the wind out of the non-interest-bearing metal. Either safe haven demand has nullified these negative forces, or some central bank is acting like a whale, using this opportunity to load up on bullion. In China, the nation's GDP stats for Q1 were released overnight. GDP growth was solid, but that boils down to an implosion in imports, which mechanically boosts growth in the GDP calculation. Instead, the real damage from the draconian lockdowns was reflected in the soft retail sales numbers. Beyond the sour mood in equity markets, this is another reason why the Australian and New Zealand dollars are trading so heavy today. This is today's Daily Market Comment. Thanks for joining us at XM.com.